Don't trade against the trend. You heard that one before? What they don't tell you is that you can position counter trend and find one of the best setups possible. But there is a trick, and that trick is what we call it as time frame confluence. We are going to take it step by step, explained in the most simple way. And the first step when we get in our desk and open a chart is to identify the trend that market is following, and to identify the trend, we must know the swing points the price action is forming. The swing points are the extreme levels of the price action. We find them by connecting the beginning of a larger movement to the end of that movement. We have two parts of these swing points. We have the swing highs and we have the swing lows. In this market, if we look at the swing highs, which they are the upper extreme levels, the recent high has ended below the previous high, meaning that the new high is lower than the last high. So this means that we have a lower high swing point. And now let's look at the lower extreme levels, and we see that the recent low is also lower than the previous one. That happened because the price basically pushed down and broke below the previous low. And if the price broke down the last low, that means that the new low has ended lower, on a lower low swing point. When a market is printing a price action where we have lower high swing points with lower low swing points, we know that the market is following a downtrend, and a downtrend is essentially just the repetition of this pattern. That means that from the last low, we'll probably see some upside action for the price to find a high, and because we're in a downtrend, that high will most likely end below the last high, because if it breaks above the last high, that would no longer be a downtrend, but that would shift the trend into an uptrend. And at some point, that will happen. But we don't want to predict. We only react to what the trend is saying. So if we take into consideration that this new high should end below the last high, we need to know where exactly this high will end. But we can't know with such certainty. We can only know with a probability, and that probability is that highs on a downtrend will often end on a supply or resistance level, which they are taken from the previous high. And to be more specific, that supply or resistance is the last upside candle before the price started pushing back down. That's this entire candle. This is our high time frame supply. Now normally we would use this supply level to plan a sell setup similar to this one, where we place the entry on the bottom of the high time frame supply, with the stop loss above the last high, and take profit below the low. And this works just fine and is more of a swing trading approach because after all, our expectation from this supply is for the price to reject back down so it can end on another lower high swing point that was then followed with a lower low swing point. But before that, the price right now is sitting here and it's looking like it's about to begin to pull back to the upside. And as we know and said from the swing points and trend theory, the goal of this pullback is to end on the supply level. So we also know that the price right now has a good chance of going up, and we can take advantage of this pullback from a low time frame. So when the price begins the upside pullback, we enter into a low time frame. In this case, we're now on the 4-hour time frame. And right now, we've entered into the 15 minutes time frame of the same market at the exact same level. Now on the low time frame, we also want to know the swing points. But this time we need to know the swing points of the internal price action. We basically just connect the swing levels. Essentially, we follow the direction of the price. And as you have seen on my channel, I mark this direction with lines and arrows to make it simple and visible to notice. For example, we can now easily see that the swing highs were constantly lower than the last highs, so we're having lower high swing points. And also we can easily see that the swing lows were as well constantly lower than the last lows, so we're having lower low swing points. Now you must pay close attention to what happened on the last two swing points. So from this lower high, the price pushed down to form a lower low. But this time, the price didn't break below the last low to form that lower low. And instead, what it did is that it ended above the last low. If it ended above, that means that it ended higher than the last low. And that means that we have the first higher low swing point on this price action. And from this higher low, the price is pushing up to find a high. Now if this high can break above the last high, and especially with a candle closing above it, then the downtrend will end on this 15 minutes time frame, and the trend is reversing into an uptrend. But the break must happen with a closing candle. Unless that happens, we're still on a downtrend on this 15 minutes time frame, and that's why we do nothing about it. We don't force anything, but we just wait and react only when something happens. So far it's going sideways, and I think a candle might have broken the last high. Let's check. And yes, we see here a candle closing above the last high. Even if it's one candle, it's enough. Some still consider the breaks as being valid, even if they happen only with a wick. For example, right here it is broken with a wick above the last high. But this can get too risky in some situations where you can expose yourself to a possible trap, and the market could just as well reverse back down and trap you. This will happen less if you only consider valid breaks, those ones, where a full candle has closed above the last high. But now let's come back and ask, why do we care about this break? And we do so because it's the first higher high we've had on this price action. So basically the price broke up above the last high, and that first break is what shifts the downtrend into an uptrend. But on this 15-minute time frame, because it's a break of the last high, but that high is an internal high of the 15 minutes time frame. The reason this is super important to understand is because if we know that on an uptrend we have a higher high swing point that is then followed with a higher low swing point, we would know that after the price broke above the last high, the market will eventually pull down to find a swing low. And that low on an uptrend should not break the last low, but it needs to pull back down and end above the last low. So basically, after a higher high swing point, we want to see a higher low swing point. And after a higher low, we expect a higher high, which is a break above the last high. Essentially, this is what is an uptrend. It's a repetition of this swing point pattern. So if we expect the market to form some kind of downside pullback, and on an uptrend we know that this pullback should end above the last high, then it makes sense to buy this pullback with the stop loss below the last low. But the question is, where is the entry? Where exactly should we enter the buy position? And that's where demand and support levels are good for, because on an uptrend, the price will usually end its pullback on a demand or support, and that demand or support is formed from the previous low. And to be more specific, that demand level is the last downside candle before the price started going up. That's this entire candle right there. That's the demand from the 15 minutes time frame, and it's from this demand where we can plan the buy position, with the entry placed on the top of the demand and stop loss below the previous low. And we place the take profit on the top of the high time frame supply. And let's come back into the high time frame to explain why is that the case. By doing an analysis of the swing points, and more specifically the external swing points, we notice that we have a downtrend price action that is formed from a push to the downside, followed with a pullback to the upside, then another push to the downside which breaks below the last external swing low. And now if the downtrend keeps holding, we should have another pullback to the upside, with the pullback ending on the high time frame supply we identified in the beginning. So if we expect with some approximation that the pullback will end on the supply, then it makes no sense to have the take profit above the supply, or even inside the supply. And that's why the take profit is placed at around the bottom of the supply, because we don't know where exactly the pullback will end, we just know that it has a good chance of ending somewhere inside of this level. And what we basically do is that we take advantage of this pullback. So even if the market is following a high time frame downtrend, we can still plan a buy setup, but from an upside pullback on a low time frame. Price pulls back into the low time frame demand, opening the buy position, and we also notice that soon after the demand has been hit, the price is starting to bounce up. That's a really good sign, but we need this upside momentum to keep holding. It just broke above the last high, so that's another good sign of uptrend continuation. But we also need to be careful because, as we know, after the price breaks above the last high, the price will often start pulling back down to find a low. But for this setup, we only need for that upcoming low to not break below the demand. So as long as it doesn't break down the demand, the position is still running fine. See, that's the downside pullback, but was then quickly followed with a push to the upside, approaching the high time frame supply. It tried to retest the demand once again, but eventually the price went up after market close. However, what we care about is that it eventually hit into the take profit target, which also means that it hit into the high time frame supply. And if we switch back into the high time frame, we notice how the price pulled back up and hit the high time frame supply. And after hitting the supply, the price rejects down and holds the high time frame downtrend by breaking below the previous external swing low. So what we did is to trade the upside pullback, but doing it from a low time frame. Now if you found any step difficult, feel free to watch more of my content, and you also have our program linked in the description, where our focus is not only winning, but most importantly, not losing the wins back. Have a great trading week.